Welcome, everyone, to the TF Team Tax Planning for Ontario. Getting it right 2026 from the start. So today's agenda, we'll talk a bit about my background, the webinar objectives. The main topics of the presentation today will be, first, we'll talk about an introduction to Canadian taxation, the purpose of this of tax planning. Are we doing it right? What are we missing? And the important stuff, the strategies to save on taxes, and why strategies alone do not work, and how we could help people move forward. And if you have any questions, by all means, by the end, I will do my best to answer any questions you may have. And then we'll talk about what's next. All right, so who am I? I often ask that question. Well, I am the founder of the TF Team, and TF Team stands for Tomaszek Financial Team. I'm also professor at Humber Polytechnique and George Brown Polytechnique. Over 30 years of financial planning experience, so goodness gracious, I've been around for a while. Former banking general manager and financial advisors at numerous financial institutions. I hold my MBA, LLQP, Certified Financial Planner, CIM, and also not included the Chartered Financial Planner designation. So hopefully that means I know what I'm talking about. All right, so what are the webinar objectives? So really, it's not to criticize or say you're doing things wrong, because there is no perfect tax structure. Everything is it's always different for every case. But there are certain things that that we do that could go awry. So understand where we go wrong. Understand strategies, which is really the main focus today, strategies to help reduce your taxes, and understand the importance of a financial plan. Really, you don't want to do your taxes in isolation. It has to coordinate with your overall financial plan. So this is what we'll focus on this evening. So we had a podcast earlier today. I had one of my international students who looked at their first pay stub, and she was a bit confused, kind of like this guy. Yes, so a lot of times after you see your first paycheck, you start out with this big number, and then by the time it's deposited in your bank account, you've got this little number that's deposited in your bank account. So yes, we all have kind of that similar reaction to looking at our first paycheck or our weekly or biweekly paycheck. So number one, are we doing it right? Well, there's no perfect tax setup. There is a reasonable versus a risky way of doing things, and we're going to look at doing it reasonably. Isolated decisions, not bad intentions. So they're not bad intentions. So everything kind of coordinates. So we don't want to make decision in isolation. Everything's got to fit your particular plan. So what are we missing? Well, timing. We often delay. We're procrastinators, myself included. We know we've got till April 30th, but we delay. And sometimes the delay could cause certain penalties. And a lot of times we'll use all kinds of accounts, TFSA, RSP, and without any coordination, we don't know which one is best suited for us. So again, everything has its place. So we're going to look at doing a holistic plan, and tax planning will fit into there. Hopefully, there's no irreversible decisions that you've made. Hopefully, there are some. If you've made the wrong decision, well, there's hope that we could reverse it. But bottom line, what I would like to look at is doing tax planning for the family, not individually, but for the family. Well, if you're single, well, then maybe it's not tax planning for the family. But if you're living at home with parents, it still will be considered tax planning for family. So we'll look at we'll look at ways to reduce the overall tax burden for the family. So first, let's start. Introduction to arcane taxation. So in Canada, we pay a lot of taxes, right? So we're bound to, we say that we have a progressive tax system, which basically means the more you make, the more you pay in terms of taxes. So every Canadian that's a resident of Canada, so you don't have to be a permanent resident or even a citizen. If you are in Canada for 183 days or more, you have to file a tax return and include your overall, your worldwide income. And as you can see, once you get to about $250,000 at the federal level, and in Ontario, if we combine it with Ontario, we're almost paying 50%, 33 plus 13.16 on that threshold of income above about 253,000 and change. Almost 50% of that is gone in taxes. And yeah, we're doing well at 250, but we're definitely not flying on a G5. We're not buying Maybach cars or Bugattis, but we're taxed as if we're billionaires at that particular threshold. So we want to look at ways to minimize the tax burden for the family earning in that tax bracket. Now, did you know, well, if you're one of my students or former students, you know this, that you'll pay about 50% or more of your income in the form of direct and indirect taxes. So what does that mean? So let's just take an average income. So let's say about $75,000 a year. So roughly about 20% of that will go in terms of direct taxation, federal and provincial tax. So now, we're at 70, 20%, so that's 14,000 gone. So now we're down to 56. So 56 after tax income. Well, guess what? We've got to, if we buy something, we've got to pay HST. So in the province of Ontario, HST is 13%. And if you work for someone or work for yourself, you've got to pay CPP. So that's almost 6%, 5.95. And then EI, that it's almost close to 2%. And then if you're like me and you drive everywhere, well, then guess what? On top of the HST, there's gasoline tax in Ontario, about 9 cents a liter, federal gasoline tax of 7 cents a liter. And then if you're lucky enough to be one of the lucky Canadians to own a home, well, then you've got to pay property tax. Add it all up, it could be a very frightening number, well above 50% of your income in one way, shape, or form is gone in the form of either direct taxation or indirect taxations. So what can we do? Well, we'll have some tax planning. The main goal of tax planning is to legally minimize, defer, or avoid altogether taxes to optimize your family's overall financial position. So how are we going to do this? Well, we've got to be proactive. It's not a one time, it's not a February or March timeframe that we do this. We do this year round, whereby we're going to stay on top of things to ensure that we are able, if possible, to completely avoid paying taxes by keeping more of our income in investment growth rather than just, filing a piece of paper at the end of March or April. So, what are the strategies? So, what could we do? Well, number one, all right, it's not a strategy per se, but it is file on time. The filing deadline for this year is April 30th for individuals, for you and me. If you file after April 30th, even if you're one day late, you file on May 1st, and if you owe money, there will be late penalties. So of 5% right off the bat, plus 1% per month, completed months that you are late. So let's avoid those nasty penalties. So, example that we have, if you owe $5,000 and you were supposed to mail it in or file by April 30th, and you filed on July 23rd, well, then your penalty will be $350. So that's 5% of 5,000 plus 1% for being late in for May and another percent for being late in June. So that's 2%, 5 plus 2, 7% of 5,000, which equals 350. And if you don't have the full $5,350, they're going to charge you daily interest. And that daily interest right now is at 7%. So we file on time. So what's the main strategy? The main crux of today we're going to talk about is income splitting strategies. We want to split the income between our family. Yes, we've talked about making 253. What if we split that between two family members? Then we would save a lot of tax. So in our example, we've got two families. Family one, each spouse is making $90,000 a year with a total income of 180. Family two, who lives right next door to family one spouse stays home, spouse number two goes to work and makes 180. On paper, family one and family two, they make the same amount of gross income. But after tax, family one is way better off than family two. Why? Because family one, they're taxed in the green tax brackets, right? The first two at 14 and a half and 20.5%. Where family two, the bulk of their taxes will be in the middle two tax bracket. Yes, they're going to be taxed, in the green at 14 and a half, 20 and a half, but a significant portion of their income will be taxed at 26%, and a small portion will be taxed at 29%. So what does that mean? That means that family one has more money in their pocket compared to family two, and all that extra money will go towards meeting their familial goals. So income splitting is kind of the key to everything if you're living either common law or if you are legally married. So living common law means that you've been in a conjugal relationship with someone of the same sex or opposite sex for 12 months or more. But if you have a child together, then it is automatic. If you're living together, you don't have to wait the 1 year, the 12 months. So what are some ways that we could income split? If you have a spouse, you could save money in a spousal RSP. So we have a higher income spouse and a lower income spouse. So the higher income spouse will contribute to an RSP for the lower income spouse. So the higher income spouse, they will get the tax deduction, but we will build the assets of the lower income spouse so that at retirement or when they take the money out, they'll be in a lower tax bracket. And we will basically split the assets. So we don't want the higher income spouse to have all the assets and then the lower income spouse have very little assets. So what we're trying to do is to split it so that each of them are more like family one, where it's almost like a 50-50 split. So a spousal RSP is one of the techniques that we could do to income split. You could also split your pension income. So your pension, that you have. So let's say you have a pension from, let's say, GM, or you have a pension from the police, the teacher. So if you've got what is known as a defined benefit pension plan, and you're receiving X amount of money on a monthly basis, you could split that pension, and it doesn't matter how old you are. So if you're taking an early retirement at 50 or 55, you could split your pension with your spouse. Again, trying to be more like family number one. If you have RSPs and you're about to retire, convert the RSP into a RIF and generate income. So a RIF, we're basically taking money out. And when you take that money out, split it with your spouse. So again, trying to be more like family one, but you have to be age 65 or older to split the RIF income. Another income splitting strategies, we want the lower income spouse to do all the investing. So if they're going to invest in a taxable account, like a non-registered account, we want the higher income spouse to pay all the expenses, the groceries, the the housing costs, all of that. We have the higher income spouse pay for the expenses, and we have the lower income spouse invest in his or her name. So, what does that mean? When the lower income spouse invests in his or her name and generate income, that income will be taxed at the lower income spouse's tax rate as opposed to the higher income spouse tax rate. So, we want the higher income spouse to pay all the expenditures and the lower income spouse to invest in their name. So that there's a bit of planning that needs to be done. If you're doing well and we have, let's say, a lower income spouse that is, staying at home, and maybe not working, and we have a higher income spouse who is going to work, we could still look at splitting the income. This is what higher income earners tend to do. Instead of giving their spouse money to invest, they will lend them the money to invest. We call that a spousal loan. What that does is it builds the lower income spouse's assets. So at retirement, again, they will be on an equal or a level playing field. And the income generated by the lower income spouse. So let's assume that you lend $100,000 to your lower income spouse at the prescribed rate, and right now it's at 3% and scheduled to go down. So I lend my lower income spouse $100,000, and let's say he or she invests and generates income. So let's say they generate dividend income, interest income, capital gains income. Well, that income will be taxed in the lower income spouse's tax return as opposed to the higher income spouse's tax return. Because if the higher income spouse would invest the money on their own, they will be taxed at a higher rate. Now, the not necessarily a drawback, but one of the caveats to that is that the lower income spouse has to pay at least the interest component on the loan. So 100,000 times 3%, so they would have to pay at least $3,000 of interest for the year by January 30th of the following year. That $3,000 that they pay in interest will act as also a reduction on the lower income spouse's tax return. That $3,000 in my example that they've paid to the higher income spouse, the drawback is that that will become income for the lower income spouse. But the strategy will work if you're generating more income than the interest that you are paying. And again, this is due with planning, whereby we'll look at various investments to ensure that you generate a higher return than 3%. Utilize tax advantage accounts. There are so many registered account. So there's a new one that came about a few years ago called the First Home Savings Account. So if you're going to buy your first home, you want to open one of those. The contributions are like an RSP contribution, which are tax deductible, which will reduce your income. And the withdrawals, when you withdraw in the future to buy your first home, it's tax free. So it's like an RSP. So it kind of meshes the benefits of a TFSA and an RSP. Probably the number one tool that you probably want to use is an RRSP, and the RSP reduces your taxable income. So most Canadians have probably heard of an RSP, and you want to contribute towards an RSP prior to March 2nd this year in order to be eligible to get the tax deduction for 2025 taxation. Now, those two accounts, we'll go in depth. We're having another webinar in March, where we're going to talk about first-time home buyers and strategies to purchase your first home. And you'll see that those two accounts will play a vital role in our particular strategies. So utilize those tax advantage account, first home savings account, RRSP, spousal RSP if you have a spouse. Either way, it will look at your situation to see which one best fits your particular situation. Other tax advantage account, if you have kids, are ESPs, Registered Education Savings Plan. So that one will not reduce your income in any way. You don't get a tax deduction, but you put money into this account and it grows tax free for up until your child goes to post secondary education. And then at that time, you will withdraw the money to pay for the tuition, their books, or their lodging. And when you withdraw the money in, let's say, when your child turns 18 or 19, well, that money will be taxed in the child's hand. And since the child will, have very little to no income, well, they would pay no tax. And you have the benefit of putting money in and it grew tax free for 10, 15, 18 years until the child goes to school. And finally, the main reason, who else could give you a 20% return on your investment? A guaranteed 20% return. Yes, some of my clients, last year did about 23%, but there was risk involved. Here, with an RESP, the government guarantees you 20% return on your contribution, and that goes towards the Canada Savings Grant, Canada Education Savings Grant. So to a maximum, the Canada Education Savings Grant is to a maximum of $7,200 per child. So you want to get the free money that the government provides you with. So where else could you get a 20% return on your contribution? So open that RESP. TFSA, well, everyone pretty much knows about the tax-free savings account. If you've got money and you don't know what to do with it, I would say put it in a TFSA until we could work out a plan as to determine if it's best suited for an FHSA, RRSP, or what have you. The TFSA, the beauty about that is that it grows tax-free. So you put up to a maximum of $7,000 a year and you invest in any type of investment, stock, bonds, mutual funds, even if you like crypto, you invest in any kind of investment, and that money grows tax free. And unlike the RSP and the RESP, when you take it out, you pay no tax. It's not considered to be income. And unlike the RSP, when you make a withdrawal out of your TFSA, you could always put it back into your TFSA the following year. So you never lose the room. So the TFSA offers you so much flexibility. This is one of the rare ways that you could avoid paying taxes altogether. So let's see how a TFSA could fit your particular situation. And the last tax advantage account that there are others, but the last one that may be relevant that a lot of Canadians have not fully utilized, it's the Registered Disability Savings Plan, RDSP. I came across an amazing stat of the roughly about, I believe, about 6 million Canadians that are eligible to for the federal disability tax credit. So this is the tax credit that basically states by a medical practitioner that you're not going to be able to go back to work anytime soon, right? So you've got a prolonged and severe disability. So there's numerous Canadians that are eligible for the federal disability tax credit, and they're entitled to so many benefits, such as the ODSP in Ontario. But of that amount, only 33% use an RDSP. And the beauty about the RDSP is that the government will give you a grant on the first uh, on on the first $500, 200% grant, first $500 contribution, and then on the next $1,000, 300% grant. So if you make a contribution of $1,500, the government gives you $3,500. So you made a $1,500 contribution, and in your account, you've got $5,000. Where else could you get? I mean, the RESP, the grant was 20%. Here, you're getting up to 300%. Where else could you get that? All you have to do is contribute, kind of a minimum of, five up to 500 to get the 200% grant. But let's say you don't have the money to contribute. I get it. Times are tough. Inflation, grocery bills, gas, things go up. Even if you don't make a contribution, and if you are in a low income threshold, right? So, or if your family is in a low income threshold, as a disabled individual, the government gives you $1,000 grant per year without contributing, to a maximum of $20,000 in Canada Learning, in a Canada Learning Bond, or actually not a learning bond, just a Canada bond in the RDSP. So you get two benefits. You get the bond, $1,000 a year, plus up to 300% in a grant that the government provides you. One, you have to contribute. The other one, you don't have to contribute. You, as a disabled person, if you're 18 or older, have to be below making about $40,000, really around 37,000 and change. And if you're a child, then your family has to earn less than about 37,000. The good thing about this is that as a child, you may not be eligible for the bond because your family makes more than about $38,000 a year. But by the time the child turns 18, then we no longer look at the family's income. We now look at the child's income. And maybe at that time, the child will make less than the threshold. So please utilize, if you know someone, or if you are eligible for the disability tax credit, just open an RDSP, please. If not, we'll help you to do it. Now, with all those ways to become more like family number one, right, whereby we're able to split the income and bring our income down to a certain threshold, well, then guess what? We will be able to receive and maximize all these family tax credit and benefits. Number one, Canada Child Benefit. So this is receive tax-free monthly payments. Where else could we get tax-free monthly payments? Everything is taxable for eligible families with children under 18. Now, the kind of the threshold is kind of around 200, 200 to 250. At 200, you still get some, but it's severely hampered, reduced when you make, more than 200,000. So not a lot, if you're making 200, you're doing well. So, but most Canadians are not making 200. So this Canada Child Benefit is accessible to many, many Canadians. So again, if you're making $200,000, then if we were able to split that income, spouse one makes 100, spouse two makes 100, and take advantage of various RSP deduction, FHSA deductions. Well, then guess what? Maybe we get even lower than the 200,000 threshold. And then we also have the Ontario Child Care Tax Credit. And this one, the threshold slightly less than the 200,000. So this one, it'll be eligible for families whose family income is, or family net income, I should say, less than 150,000. And you could claim up to 75% of childcare expenses like daycare, camps, nannies, and so on. So really, let's look at ways to minimize our income to, let's say, the $150,000 threshold, and we would be entitled to all of these benefits, these tax-free income and tax credits. And also the Ontario Tax Reduction and Lift Credit. This is available for really low to moderate income families. And they could use the Ontario tax reduction to reduce the provincial tax. So this is really aimed at reducing your provincial tax, not the federal tax of Ottawa, and the low-income individuals and families tax credit to reduce your taxes per couple by up to $1,700. So the tax credit is a great tool because it reduces your tax payable dollar for dollar. So you could save $1,700 in taxes for the family. Other family tax credit, the child disability benefit. Again, if you are eligible for the federal disability tax credit, you will be entitled, or if your child is eligible, they will be entitled, on top of being able to open an RDSP for them, they could receive a tax-free benefit. All right. If your child is under 18 with a severe disability, and guess what? What do you do with that tax-free benefit? Put it into the RDSP and have that continue to grow, again, tax-free. Up until, I should have said, up until age 59. You've got to withdraw money from your RDSP by age 60. And then Canada Workers Benefit. It's a refundable tax credit for low-income working families. So again, they don't look at your total income, at your take-home pay. They look at your income after we've taken into consideration various deductions like your RSP, your FHSA, if you've got childcare deductions, if you've got moving expenses. So you can make $100,000 and take advantage of, the RSP, the spousal RSP contribution. And then we bring your income down to about 50,000. Even though you've made 100, you would be entitled to the Canada Workers Benefit tax credit. Other eligible tax deduction, well, I've kind of touched a bit about it, childcare expenses. Just note that for childcare expenses, only the lower income spouse can claim childcare expenses. That's if you are a couple. If you are single, then by all means, the custodial parent will be able to take care of childcare expenses. But if you remember, family one and family two had spouse number one made no money and spouse number two made $180,000, in that situation, only spouse number one, who makes zero, could take the eligible childcare expenses. And guess what? They make no money, so that childcare expenses would be wasted. So if we were the family one situation and they made any money, well then they could deduct the childcare expenses and probably bring their income close to zero. Medical expenses. So medical expenses, so those are your, your dental, and some medical prescriptions, because the fallacy in Canada and Ontario is that healthcare is free. Well, there's, if your parents ever told you, there is no such thing as a free lunch. So there are some out-of-pocket expenses, especially when it comes to dental. You if you're lucky enough to belong to a company that pays group benefits for medical and dental, then that is great. You won't have to worry about paying a great deal of money towards dental and other healthcare. But if not, well, every visit to the dentist, you're going to have to use Visa, MasterCard, or American Express. The good thing about that is that, excuse me, if you're going to have to pay out of pocket, then you could claim a potential tax credit on that. And again, tax credit reduces your tax payable dollar for dollar. But you have to compile all your your medical expenses within a 12-month period. But the 12-month period doesn't have to be between January 1st and December 31st within a calendar year. Figure out which of the 12-month period that you've paid the most in medical expenses and claim that particular time frame. So it could be from March to March. Excuse me, let me just take. See, I'm in need of medical expense. I may have a bigger bill on my way home. So again, if you have a family, a family of four or more, then especially when it comes to dental, it may cost a lot of money. So at the very least, you would be able to claim that as an expense and a tax credit, which will go to reduce your tax payable. Charitable donations. Lastly, I shouldn't have put that last. Lastly, charitable donations, right? Doing the right thing. So if you go to a place of worship, church, synagogue, temple, and the place of worship is registered as a registered charity, well, your contribution not only doing a good thing for the community, but it also will garner a tax credit, which will go to reduce your tax payable. On the first $200 of your charitable donation, right? So we compile it for the whole year. You get a tax credit of 14.5%. And on the amounts above $200, then you get a tax credit of 29%. So what you want to do is contribute more than $200. So let's say this year you only contributed 150 towards your charitable donation. Don't claim it this year. Wait till next year when you're going to contribute another 150, and now you'll be at the $300 threshold. So that way on the first 200 it'll be at 14 and a half, and then on the next 100 you'll get a higher amount. You'll get double the 14 and a half tax credit. You would get a tax credit of 29%. So if you don't if you don't go over the $200 threshold in 1 year, pile it up, carry it forward. You could carry forward your donations to a maximum of 5 years. So you've got 5 years to get over the $200 threshold, because or else you would, you wouldn't get the biggest bang for your dollar on your charitable donation. So not only are you doing the right thing by donating to sick kids, um, the Red Cross, you name it. Church is always a good one. Again, this would be probably I shouldn't have put a number five. I should have put it higher than that. So this is a great way to save taxes and do the right thing. So we've talked about a lot of things. So why do I always owe money or I don't get a great deal of a refund? So why does tax strategies alone do not work? Well, it's got to be coordinated, right? There's a lack of implementation of those strategies whereby we do it in isolation. So we really want to get a plan and make sure that, you know what, we're not forgetting anything, that maybe this year it's not the right time to put the charitable donation. Let's put it for next year. So don't blame yourself. Remove self-blame. Nobody's perfect. Nobody does it right the first time. But what you do know now, you're armed with the knowledge that maybe you do need to speak to someone, get a plan, and shift the responsibility from yourself in a way to a team that can help you and provide you with that structure to meet your tax planning goals. So what helps people move forward? Well, I've been kind of saying about it, a financial plan. It reduces, the fear. And if it's all the information within the plan is confidential, and there's no need to feel embarrassed. I always find it funny when I meet clients for the very first time and they feel like it's like going to the dentist. I'm going to pull out their teeth, and their consultation is going to be painful. No, it's not that painful. They always come out of it. Oh, that was easy. It's almost like pressing the easy button. So let's start 2024, or it's 2024. I'm already behind. 2026 on the right step, and let's start with planning, so that way we have the structure in place. Thank you for your time. I hope that you've found this informational. And if you have any questions, I'll be more than happy to ask any questions that you may have or answer any questions you may have. It's been a long day for everyone, temperature and everything. Just note. Oh, you're welcome. Just note that if you don't have any question, or if you're thinking of something in the future, please feel free to book a free 1 hour consultation with our team. And again, the beauty about our team is that everything is done kind of free of charge and confidential, and we're here for you. All right, so here's info. Hope that you found it informational. If there's one thing that you want to take out of it, be like family number one. Let's look at splitting that income so that you can meet all of your goals. Enjoy the rest of your evening. Bye for now.